The Fed raised rates today largely as expected. The volatility that came out of today was largely as expected. Now the question remains, when is this pullback going to end? How much longer do we have? And how much longer is the Fed going to keep raising interest rates? And what have we seen from what these asset classes, markets, and Fed fund futures are telling us? I'm going to break all that down and look for a trade idea in a sector that is not part of the expected sector rotation that we're looking for into the end of the year. So let's go ahead and get started. Today is Wednesday, September 26, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the logo right here, the Market Scholars logo. Then click the red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells me you liked the video tonight and you want us to do it again tomorrow. Really easy way to give us feedback there. You can do that right now while you're watching. Comment on anything that stands out to you as you listen. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click on that link. Takes you to a page to subscribe. Really easy way to do that. Follow me on Twitter for more content like this in between videos. And join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500. You'll see that we had a fourth consecutive decline coming after the bigger range today because of the FOMC meeting. Remember, we have other things coming out the rest of this week. GDP, final revision of GDP tomorrow. And then things really start ramping up in earnest for the Q3 GDP advanced figure expected to come out. You can see the momentum line fell, not to an extreme low. It didn't drop below the 5th percentile, but the near-term line's fallen to its biggest low point that it's had. I mean, it didn't even drop this low during that intermediate pullback. This is the last time. That was the closest to an intermediate pullback that we had there, where we touched the 30-day moving average. You can see further over, it was down in here that the near-term line has gotten this low. So again, coming off a bearish divergence of these two peaks, setting the target for that divergence to right about where my cursor is, 2886-ish. All right, it's always a range. You still have a strong bullish posture, but that bearish short-term sentiment is suggesting that this intermediate run's closer to being over than it has been recently. We're getting closer to a dark pink shading. And as I mentioned before, that doesn't mean that we're headed to a bear market. It doesn't mean we're even headed to a 10% correction. There's a lot of support in this area here. Fibonacci support, old high point over there, multiple intermediate highs at that Fibonacci, at the bottom of the Fibonacci level. A lot of volume support in this area. So the fact that we're getting shorter near-term runs, we're not even getting to 7 days, much less to the 7 to 12-day normal run. We're getting divergences. We're getting longer near-term pullbacks that last more than 3 days, and now we're getting deeper pullbacks on the near-term line down into the reversal zone, significantly down into the reversal zone. So technically, we have a buy the dip signal again for the fourth day. All 4 of these days would be intermediate confirmation signals. We've seen that before, actually right here, if you were to zoom in right there. So this is back in January. We had an intermediate confirmation signal there, 3, 4, before this 5th day we finally fell enough to bring the intermediate line down. So we had 4 days there, and that's these 4 days. Now, I'm not suggesting that we're getting that kind of move now, right? Even though you would think that based on past precedent. Remember, we don't have this kind of move into that that we have here. See, this is nice and orderly, ups and downs. That was not. That was very disorderly. So, needless to say, when you get a more extended decline and multiple intermediate confirmation signals are not playing out, then you have the possibility of more of an intermediate pullback. You even have not just the near-term pullback that puts that low point right there as a target where my cursor is, that coincides with the near-term low right here. But you also see really close, you have an intermediate, you have these intermediate highs That puts this January high, this low point in question as a target, which is just above the 38% Fibonacci retracement of this current intermediate run that we're on. You take a look at the Dow Jones Industrial Average. Again, its near-term line is down very low. Its momentum line was below the 5th percentile. Still a strong bullish posture, but short-term sentiment suggesting we might be getting some dark pink shading here sometime soon. The NASDAQ Composite, take a look at it. You can see a long upper shadow today. It still has a bullish posture as well, not as strongly bullish as the S&P and the Dow, but you can see its short-term sentiment. It did cross up above 80 on this near-term run so far, at least, and neither did on the last one, really. I mean, this is dipping its toe there. So, really bearish short-term sentiment right now. The fact that we can't get a good bullish high point. Obviously, not getting up to higher highs either. Not getting the lower lows, not getting bearish lows yet. So it's not as bearish, but you can see it's we're consolidating at the end of an extended intermediate run that usually leads to this kind of a move. That the pullback move, and then finally the Russell 2000 breaking down below multiple weeks lows here. Does have the more bearish posture. In fact, it has the only bearish posture out of all of these. And you can see very oversold momentum line. Near-term line is not down there yet, but again, breaking down, getting close to dark pink, getting the closest to dark pink shading, suggesting that all these others will soon follow what the Russell is already doing. Okay, before we look at some other charts, I want to remind you, if you're watching our video through our blog, we look for 3 clicks. Brandon and I look for 3 things that tell us, hey, they want us to keep doing these videos. Number 1, you click on that heart right there. That opens up a new window where you can like tonight's Market Outlook tweet on Twitter. You can also click this image. It takes you to your Facebook page where you can like tonight's Market Outlook post on Facebook. And, of course, the third click is right there. You can do those 3 clicks right now. Those clicks tell us, hey, David and Brandon, we like it. Keep on doing it. You notice also on here you've got the calendar. Brandon's got his Q&A session tomorrow. You can see more classes of what we're doing here, as well as the recordings and what we talked about in previous classes on the events up here at the top left. Remember to participate in our forums and talk about tonight's Market Outlook with other market scholars as well as myself and Brandon. You can subscribe right here by clicking on this icon, and you can do that for free. All right, when you look at the long-term chart, again, this kind of puts this last 4 days in perspective. That's as much of a pullback as we've gotten towards the 50-day moving average. So, again, that doesn't mean that we can't pull back, but what it means is don't expect this pullback to be significantly bearish. It's just simply just a pullback as of right now. Of course, things can change, but as of right now, from a technical perspective, that's what you'd expect. Of course, you can see the Dow Jones looks very similar. The NASDAQ's closer to its 50-day moving average, and the Russell is breaking below it. So again, maybe a precursor of what we might see on some of these other charts. Let's look at the 3 green arrow charts for the S&P 500. Try that one more time. Let's do it one more time. There we go. We have 2 red arrows on the MACD and the stochastics, of course. Both of them showing divergences. In fact, you can see the divergences a lot better on the 2-line version of the chart. There we go. So lower highs crossing below their moving averages. MACD gives you a red arrow. Stochastics also giving you a red arrow. You can see we're down. The 8-day is still above the 17. We are below the 8. We're not below the 17. We're obviously not anywhere close to below the 30. So grain of salt here on how bearish we are. This is a pullback. I do expect that we'll have a bearish posture with the intermediate line dropping below 50, but I don't expect it to be earth-shattering in the least bit. So you can see how we moved throughout the day. We moved higher early, and then initially higher after the rate hike, and then really down at the then a pullback, so kind of a knee-jerk reaction, and then a breakdown right before the close. One thing I tweeted out here is this tweet from Bespoke Investments. This is the intraday period on the hike days during this particular rate hike cycle. And you can see they move higher throughout the day. Initial move higher after the rate hike is announced. Then a knee jerk to the downside. And then we kind of consolidate, and then a breakdown right before the close. So almost to a T, we saw the same pattern play out today. We had a higher high, but a lower low that dropped. You can see here that this incorporates that dividend. Let's look at the cash index for SPX here really quick. Give it a second here to load up. Okay, you can see it's dropped to its lower half. So it's, this is the move down to 29.10 that I talked about on Friday's market outlook, that we'd probably consolidate pretty quickly this week, especially considering the seasonality of the week after September expiration. Remember, this is the first rate hike in September that we've gotten in this cycle. All the rest of them were in December, and then we get March and June. We'd skip September. So you combine that with the seasonality of this week after expiration September. We were looking for this to consolidate that weirdness really quickly, and so far we have, and then a little bit more. And you can see, this isn't earth-shattering. We still haven't closed below the low of that Hakinyashi candle on SPX. So if you take a look here and then look at its Hakinyashi right here under style and chart type, there we go. You can see no lower shadow yet on this week's candle. That's the sign of reversal that we look for. And you look at SPY, and we are getting that smaller body, lower shadow. So again, this is a sign of weakness that will eventually get this kind of intermediate pullback that produces the red arrow that we're already getting on the Russell, but on the S&P 500. If you look at the range today for SP, let's go to SPY and look at the volume as well. And you can see the range was almost 3 points, 2.83 points. The volume at 79 million was above average, not quite to 1.5 times. But 79 million, let's look at it on this chart. 79 million is right about there. So above the average, but not too strong. And 2.83 is right there. Again, above the average, but not too strong. And not above 1%, right? Just about 1%, but starting to move that higher. So those are the kinds of ranges and moves that would be bearish. Now, granted, this had FOMC, so we'll see what happens tomorrow. We have GDP. But it's a final number, so it's usually not that market moving. If we continue with some pretty decent range without, a news event tomorrow, then we know, okay, we're getting that intermediate pullback. We're getting some bigger ranges. That's what you expect to see. Volatility had an interesting move. I mean, it had really dropped down. It was really close to below 80%, had dropped down below 12, and then boom, we had a big rally. Still in the neutral zone, so we're not bearish yet. I remember strong bullish posture still in the S&P and the Dow. It's bearish in the Russell, so we are seeing the signs, more signs now, and you can see VIX getting the 13s higher than it got post-expiration. So there's we'll see what the follow through is. Now I do expect there to be more follow through, maybe not day after day after day of selling, of strong selling, but expect to see more gradual, not too steep, not too strong, but more of a decline into support on an intermediate basis, then a bounce higher. So that's kind of a summary of what we're seeing with all these technical charts, including the market forecast indicator. All right, so what do you think about that summary? Do you agree with that? Do you disagree with that? Again, a strong bullish posture still, but getting more bearish. Short-term sentiment's more bearish than we've seen in a while, leading, kind of confirming some of the signs we've been seeing that this intermediate run is maturing and closer to a pullback than what we've seen previously. That we'll get that pullback sooner rather than later. And so now we're in the midst of that, at least what could be day one of more of a kind of gradual move lower into that support. Do you agree with that? Do you disagree with that? Click that link popping out in the top right corner of your screen. Either click agree or disagree. If you click disagree, for whatever reason, more bearish or more bullish, scroll down to the bottom, comment on what you're seeing that would suggest something different than what we've summarized here using our market posture routine. All right, now let's transition over to what's driving the price action here. And I wanted to take a look. Obviously, the big move today was the interest rate hike and the ramifications that came out of that. And we'll talk about that in a minute. I wanted to bring up the asset classes. You can see long-term bonds. Long-term bond yields fell. Now, they had been rallying in anticipation of this rate hike. So kind of a buy the rumor, sell the news kind of a thing. They rallied into the hike. They fell out of the hike. So bonds rallied. Again, these at alternative equity asset classes, dividend stock. Well, dividend aren't really alternatives, but you get the idea. Kind of unique. They're dividend stocks, real estate stocks, MLPs, all lagging behind. You can see value stocks. A lot of them have decent dividend yields because of their value. Small cap stocks falling, crude oil and gold falling, even though the dollar was relatively flat. Didn't really move up or down. On the other end of the spectrum, because the dollar was flat, EEM and EFA outperformed, at least U.S. stocks, continued to outperform U.S. stocks, and of course, bonds rallying. Investment grade bonds rallying, and then you have municipals, foreign bonds, and then all the short-term bonds here at the bottom, TIPS and SHY, all outpacing ACWI. So, but if you take a look at this graph, so this line right here, where my cursor is, that is the dollar. That's the U.S. dollar. You can see over the past 3 months, the S&P 500 has been your best performing asset class, and crude oil has made a run. And when has crude oil made that run? Since the dollar peaked. So the dollar peaked right here. And since the decline in the dollar, you can see U.S. stocks have been rallying. U.S. stocks have been doing pretty decently. Now, if you look at, so again, crude oil is down. Gold has not rallied, not nearly to the extent that crude oil has rallied. Long-term bonds have actually been on the decline, even with the drop in the dollar. That's this kind of green line here. This brown line, this one here, you can see that's emerging markets. So initially, emerging markets did well, gave back some gains on some brief pause in the dollar drop, and then bounces back up again during a new level of decline in the dollar. So those were your weaker asset classes, and there's EFA as well, and you can see again, big rise when the dollar initially dropped, a drop during this bounce in the dollar, and then another rise. So really, EFA has been right behind the S&P 500. So in that sense, 8.15, again, that's about the time that you had a reversal in all of these equity asset classes. So if I were to change this, whoops, nope, this one here, nope, not that one, this one, and change this to a custom chart of 8.15 up until now. We'll change that to a daily. Then you can see you can see crude oil, emerging markets, and EFA, all your best performing asset classes, all above the dollar, all above the S&P 500. On the other end of the spectrum, the dollar's been down, but so has long-term bonds, which means that bonds have been up with the drop in the dollar, which you don't usually put hand in hand, but that's been the case. You can see preferred stocks here in purple dropping, ag commodities dropping even with the drop in the dollar a little bit, high yield lagging behind stocks, and you can see IWM lagging behind the S&P during this dollar decline. So just because the dollar is dropping doesn't mean the S&P is going to drop. The S&P is going to benefit from moves higher in these international stocks. So, of course, today, the big news today was the FOMC meeting, right? And of course, they raised their interest rates. You can see the forecast came out. You can take a look through there and see how things have changed. You can see the press conference, some notes there on the press conference addressing all the things that we've talked about that's been out there. So nothing really major, but the impact, nothing new at least, but the impact of today's move, if I were to go here and then change it to just today, so we'll do custom and then we'll just do August, or see today, let's go September 26th, and then we'll do like a 5-minute aggregation. So there's the initial move right there. Initially, you can see stocks all rallied, especially and the dollar fell. That's in blue. The dollar rallied off of that knee-jerk move, and all these equity asset classes all declined. And you can see small caps declining the most from that, and you can see S&P 500, crude oil dropped, EEM dropped by the time all was said and done, and it was your bonds that finished the day higher. Long-term bonds rallied off of their lows. You can see the gold initially dropped, bounced, and then pulled back along with crude oil. And you can see foreign bonds, this BWX, holding up as well. So all the equities, even high yield, outpaced stocks there quite considerably. And it actually was flat for the day, despite the knee-jerk reaction. So the markets came out of the FOMC meeting, nothing changing here, but usually the market is pricing in the next two meetings, the next two interest rate hikes. So, the market's already expecting this one, and yes, they were pretty much expecting, you had about an 80% chance that we'd get a rate hike in December, and we still have about an 80% chance, because now there's just there's no chance, 0% chance of two rate hikes, because the odds of a rate hike in November are slim to none. Right? Very, very, minimal. 0% chance. Literally 0% chance. So we're back to we still have an 80% shot of a rate hike in December. So that's largely baked in. But the question now, the second one, when are we going to get the next rate hike, right? And that's where this becomes, it was a 50-50 shot going into today. And the question was, if the market's expecting another rate hike, then we'll move towards 60 and start moving our way higher towards 80 and above. Or we'll go the other direction. And we went the other direction. We went actually down to 41% combined. So, and then if you look at June, which would be the next meeting, if they continue with the quarterly cycle, even though they don't have to now because they're going to have press conferences after every FOMC meeting. But you can see June. So there's December's hike. You're looking at, about a what? So you have 31% odds of of just the December hike or less. No hike at all. 4% chance that we don't get another hike at all. So 27%. So 31%. That means you're about 70% plus odds of that second rate hike coming by June. So whether we'll get one in March or not, the odds have actually fallen. So the rate hike expectations are actually coming down a little bit, not rising. They're still there. We're still going to get one in 2019, but it's looking more and more, as of right now, things can obviously change. We have plenty of time before March. But as of right now, the market is more likely expecting that next rate hike to occur in June, with the economic indicators really not moving up or down significantly one way or the other, which we're just moderating. Now, GDP estimates will come out again tomorrow because the final revision to the second quarter comes out tomorrow, and then the Q3 estimates will be revised based on that. So we'll see. There's still very, very strong expectations for GDP. In fact, we continue to have pretty decent. So another reason why, there's the odds of, the seasonal move for stocks to be bullish heading into the end of the year, like we've seen the last so many years, right? If you were to do a seasonality chart and go SPX, and we'll just let's change it to a percent, price as percentage. So this is the last 5 years. Right, that's the seasonal move coming out of September, pretty much right now. And I still think we'll get more of a pullback though. But that's the seasonal move that we have coming in. Pretty much that week. Right when we have the beginnings of earnings season in Q3. That's the last 5 years. You go back to the last 10 years, and you can see again very strong seasonal move over the last 10 years, and you go back to the last 20 years, very strong seasonal move. So I just think this go around, this seasonal move will be driven largely by what we see in these international stocks, EEM and EFA, and the dollar along with it. But that's why I wanted to show you that this chart initially here was that since that August 15th time frame, when the dollar has been dropping. So let's go custom again, and then go to the August 15th. That's the peak in the dollar, the most recent peak in the dollar. We've been dropping ever since. Since then, and you can see there's your international stocks, but so is SPX. SPX has been up that whole time too. So a falling dollar does not mean a falling stock market. And you look at the foreign markets, and they're all looking very strong. You can see where SPX again is down towards the bottom of the list, but you look at the foreign market grid here, and we're still got that strong bullish posture even though short-term sentiment's dropping. You're still above a rising moving average, even though we might get a red arrow here pretty soon. We don't have to necessarily turn red like these, but just a quick red arrow, and we'll have opportunities. See all the rest of, look at all the green moving averages all across the board except for India, which is giving us oversold clusters. Look at all the rest of them, all green moving averages, which means that we're above a rising moving average. Look at the strong intermediate postures: 75, 94, 77, 84, 92, 94, 92, 95, and a couple that aren't so strong. We get the idea that these international markets that have been so beaten up are rotating in the favor right now, and that's going to be a big lift for U.S. stocks. They might lag, but they'll still continue to move higher, and that might be the macro influence necessary to fulfill the seasonal expectations into the end of the year. And not only this is that from that standpoint, but also remember the presidential cycle. These are the most bullish quarters of the presidential cycle. The next quarter, Q1 and then Q2. And then again, if we get a split Congress along with a Republican president, that's the best combination for the markets. So that would be a positive couple of years there. So from an almanac standpoint, of course, things don't always behave as the almanac says. But from an almanac standpoint, the next 6 months or so, especially with the new highs in the Dow, I've mentioned that before, we have opportunities for good moves in the markets. It might not be driven by FANG stocks. It might be driven by energy and materials and industrials with a falling dollar. We might have different leadership than what you'd expect. That might eventually move into staples and utilities and real estate if yields start coming down. So your leadership might be different, but the move might end up being the same with stocks moving higher. If I show you over the last 3 months, healthcare has been a strong sector. Industrials has shown some weakness here lately, but it's been a strong sector. And of course, technology and discretionary kind of matching the market moves over the past few months. Look at the utilities in purple, real estate in light blue. They've really been struggling. That's continued today. They continue with some pretty steep declines. In fact, if you look at the charts that they have here, and it's not just those two, you can see materials has dropped, industrials has dropped, staples have dropped, financials have dropped over this past week. So the market you see in black has been barely pulling back because you've got healthcare and technology and healthcare kind of holding it up. But look at everything else that's been dropping. And some of these even before, like utilities and real estate, but materials and energy today and state, all these interest rate sensitive, even with the rise. And if you take a look now, if we were to do the custom and just look at today, okay, let me do that. So we'll go to today here and we'll do by 5 minutes. And see the initial reaction. You can see the initial reaction is everything's higher, but by the end of it all, discretionary and consumer stocks held up by the end of the day. Financials, real estate, utilities, telecom, all these interest rate sensitive, even with the rise drop in yields, they still all declined anyway, and so did financials, so they didn't benefit. You would think, okay, well, if those fell, then financials should rise, and it didn't really help either. So, everything's dropping, which tells me this is a broad sell-off over the last few days. If I were to go back, say, let's go back the last 4 days. So this would be 1, 2, 3, and 4, and then we'll go back and we'll change it to like a 30-minute aggregate. So this is during, there's Monday to, we have to go back one more day, don't we? There we go. So Friday, there's Friday. So this is during the 4 days of intermediate confirmation signals, right? With strong posture but oversold and everything, and the Russell pulling back. So there's your S&P 500 down 1% during that, from the open on Friday. So it doesn't include that gap. Well, there was a gap higher actually on Friday. So down 1% since Friday's open, not Thursday's close. You can see energy is held up okay. Healthcare is held up okay. There's your technology and discretionary, but look at everything else. Industrials, materials, staples, utilities, real estate, financials, broad sell-off. Broad sell-off. There's your previous leadership. They've held up, but everything else. And a lot of those are giving back here after the Fed, the Fed move. They finally kind of joined the party. They were holding up okay, but everything else was down a notch or two. They appeared now to be holding the party. So again, a sign to me that this little selling could eventually lead to that expected intermediate pullback that we've been waiting for the, at least that I've been talking about for the last week or two. All right, so let's take a look in this financial sector again. We've looked at this sector in the past, and there's, it's making another run to the downside. In fact, you can kind of see a little bit of a triangle forming here, or descending triangle, whatever you want to call it, on Morgan Stanley. We'll pick on Morgan Stanley this time. I think we did JP Morgan last time. But you can see it's pulling down. It's setting up for a breakdown to the downside. Of course, it's got earnings coming up here, so we'd want to manage the risk of that potential move with smaller positions than normal, or maybe even get out of that position. This is a trade. The earnings come out. Let's see, what's the date? 10/16. So you do have some time before that. You can see things are rolling over to the downside on the stochastics. In fact, if you take a look at like Bollinger Bands, we are falling toward, there's some support down here. We've broken through the biggest volume node level today, so kind of a breakdown to the downside on volume. That's obviously had an impact on the directional movement index, with the orange line crossing back up above 25 and the positive line crossing back down. You look at things like the market forecast indicator, back to a bearish posture with very strong oversold short-term sentiment. Of course, the long-term view of these financial sectors, you can see, of course, we got one more day left, or excuse me, 2 more days left in the week, but so far a pretty bearish candle for the week with this death cross that we've had. So things still aren't looking, and as far as expected sector rotation, financials is not on the list, right? A weaker dollar and rising yields and falling yield spread is usually bearish for a sector like this. So, and you can see it looks like it has the makings of another leg lower if the current moves continue to play themselves out. And of course, we can trade that really easily with a vertical spread. All right, if you don't want to short the stock, you can obviously buy a put option. Higher probability trade would be to short right around the short the 50 strike, buy the long strike. The paper money prices are off a little bit, but right now the mid price is at 48 cents for that particular option. If you were to analyze that trade, here, let's do a single symbol. Analyze that trade and set that slice to break even for 11.17. So that would be right in here. You can see pretty decent odds. Now remember, there's that earnings. So if we can hit our target, if we can get most of that credit, see if we can get like half of that credit before, if it makes a couple of point drop here and continues lower, that would be our ideal scenario with your stop order. If I were to go back to the Bollinger Bands on this, your stop order is actually, or break even, excuse me, is actually above these highs. So a positive sign. Lots of volume up above where we're at. Lots of volume below the break even. So I mean, it would have to take a surprisingly bullish, which we haven't gotten here. That's really kind of broken it out of the trend of the move that's in. This is probably the most, and even then it was a bullish move heading into it. But this is the biggest move it's made on earnings day outside of what it was already making. So that's the kind of move. It actually would have to be stronger than that to get up through two now big volume nodes and get on the other side of these old highs, as well as the Bollinger Band and that break even. So you have good opportunity for bearishness to the downside on the sector, especially when looking at the long-term chart and the floor, the triangle that we're forming here, and the expectations that you come out of the triangle in the same way, same direction that you are going into the triangle. All right, so that wraps us up for today. Now I want to hear from you. What do you think? What do you think about the moves today? What do you think about what we've talked about in the market outlook tonight? Do you have any questions or comments about what I've discussed? Do you have any questions or comments about something I did not discuss that you notice that you wanted my take on? Remember to click that link that's above the video that takes you to the Market Outlook forums on marketscholars.com. You can also comment on the YouTube video, as well as if you scroll down and leave a reply on today's blog post as well if you're watching this through the blog. So lots of different ways to interact. Of course, the best way is in with our community, our Market Scholars community, a lot of whom have been watching videos like this for years, and can be able to strike up a good conversation on what was discussed. As always, thank you very much for your time tonight and for watching the video. Remember to subscribe to our YouTube channel, click the thumbs up icon, comment. Also remember to follow me on Twitter for more content throughout the day in between videos, and join our community on marketscholars.com for free, as well as on Facebook, our Market Outlook community on Facebook. Have a great rest of your evening, everybody, and we'll see you all next time.